Hello everyone. Well, we've got a couple of weeks now since new Governor Mark Carney engaged in his new forward guidance, and we've got a good feel of what the markets think of it, which actually so far is not very much at all. If you look back to the day that forward guidance is introduced and you look at the time the governor starts his speech at the press conference, you'll see that shortly beforehand, market interest rates, long-term interest rates for UK government bonds and sterling were falling. And that's really what the governor and the Bank of England would want, because that means that companies and consumers are paying low amounts for their long-term borrowings and mortgages, and also that with a lower pound, our exports are more competitive. But within a matter of a couple of minutes of the governor starting his speech, the exact opposite happens. The markets start to push sterling up, and it appreciates by about 1.7% on the day against the dollar, and UK interest rates also start to go up. Now that's interesting, isn't it? Because what seems to have happened is that as forward guidance has been introduced, the market have taken this to mean that more words indicates perhaps less action. And bearing in mind that on the February, March, April, May and June Monetary Policy Committee meetings, the ex-governor Mervyn King was outvoted in trying to introduce an extra 25 billion of quantitative easing. Perhaps we're in a situation where action is more difficult and talk is cheap. If that's what the Chancellor expects from forward guidance, forget it. The markets are much cleverer than that.